Hello and welcome to FT Markets. Records were being set in the German bond market on Tuesday as negative yields pushed ever further below zero. Investors are prepared to hand money to the German government and pay for them to look after it. To help us make sense of that, we're joined by a bond investor, Nick Gartside, who is a Chief International Investment Officer for JPMorgan Asset Management Fixed Income. Hello, Nick. Thanks for joining us. So I think what we're really after is trying to understand the world we're in now. And I think you've got a great chart here which sort of illustrates one of the most important things for bond investors, sort of the state of inflation.
No, that's key. If you think of bond investors, we have two enemies. Our enemies are growth and inflation. When we look at the growth side, let's be honest, growth is lackluster. But inflation is where the real story is. And when we look at the inflation outlook, the question is, where is it? And just this year, if we take the Eurozone, when you look at the Eurozone at the start of this year, our sense was inflation would settle around 1% by the middle of the year. Recent falls in commodity prices mean it's unlikely to get to 0.5%.
And I think we could see that here, the sort of the collapse in expectations for sort of price growth going forwards.
It is, and that's an international phenomenon. It's not just the Eurozone, it's the UK, it's the US, and also Japan. What that means is that the risk is that central banks are much, much more aggressive when it comes to easing monetary policy.
And so as a bond investor, sort of if inflation is falling, then that means you're relatively safe. Your income isn't going to be eroded by sort of the value of money running away from you. And so I think we've got another chart here of sort of where you might be looking. And this looks a bit like a game of spot the odd one out, I think.
It is. There's a few messages here. The first message is that just because bond yields are low doesn't mean they can't go lower. Think back to 2015, one of the best performing bond markets was the Japanese government bond market. Made you 1%. That's positive 1%. When we look at the bond universe today, the standout is US Treasuries. If you were to look at every government bond in the world, rank them, around 80% yield less than a 10-year US Treasury. When we look at 10-year US Treasuries, the risk is that yields go significantly lower from where we are now, much closer to where the international bond markets are.
That's a bit counterintuitive, isn't it? Because the Federal Reserve has just raised interest rates. The US economy is supposed to be recovering. So shouldn't we be anticipating higher interest rates from here?
We should, but again, think back to the backdrop. We've got a low inflation outlook in the US. We've got a low and very pedestrian outlook for growth. So one of the very valid questions now is, did the Fed make a policy mistake in December? Irrespective of that or not, when we look at the rate cycle in the US, it will be slow, it will be sluggish, and it will be a very, very shallow peak in rates. All of that is good news for Treasury yields.
And I think just one more idea you've got for us here is if we're looking for places where yields are still attractive to fixed income investors, we've got one more chart with a suggestion here.
It is, and it's Italy and it's Spain. When we look at those bond markets, we think they're a steal. So think of those as spreads to Germany. That spread to Germany is around 1% today. Now, you look historically, and spreads got very, very tight. We're not saying that they can go back to zero levels. They can halve, though. They can go from 1% to 0.5%. So if you think in total return terms, there's no reason 10-year Spanish and Italian bonds can't give you a total return this year in and around 5%.
Thank you very much, Nick. So it looks like as we contemplate this world of record low yields and very limited returns, there are still opportunities to be had.